and welcome to BFSG's Fiduciary Education Training. This video is intended to introduce you to your role as a member of the Retirement Plan Committee and the responsibilities of being a fiduciary to your retirement plan. By the end of this video, you will have gained an understanding of what it means to be a fiduciary, the liability that comes along with it, legal standards set forth by ERISA, and fiduciary best practices. So let's dive in. What does it mean to be a fiduciary? Well, before we define a fiduciary, it may be helpful to understand all the players within the retirement plan ecosystem. In addition to the retirement plan committee, there's many players involved in making sure a retirement plan runs smoothly and follows the legal requirements necessary to stay in compliance with government regulators. In 1974, the Employee Retirement Income Security Act, or ERISA, was signed into law to set minimum standards for how retirement plans can operate and protect the individuals that invest in them. The two agencies that have primary jurisdiction over retirement plans are the IRS and the Department of Labor, or DOL. The IRS has jurisdiction over the qualified status of retirement plans and is primarily responsible for the participation, funding, and vesting rules, while the DOL oversees fiduciary standards of conduct and reporting and disclosure requirements. Next are auditors. Generally, an annual audit is required for plans that have 100 participant balances or more on the first day of the plan year. The audit is necessary to complete the plan's Form 5500 filing, which is basically a tax filing for retirement plans, and also includes a summary annual report that must be sent out to all participants annually. The next major player is the plan's record keeper or administrator. There's dozens of record keepers in the industry, and their primary responsibilities are to maintain participant accounts, provide benefit statements, and facilitate transactions such as changes to contribution rates, investment changes, taking loans, and making distributions. And finally, your plan may hire an advisor or consultant to assist with the oversight of the plan's investment options, benchmark record-keeping fees, provide policies and procedures to maintain proper governance, and some may even provide participant education services. An advisor consultant would be considered a fiduciary to the plan, and your plan administrator may have some fiduciary responsibilities in administering the plan. However, auditors are not fiduciaries. So now that we have a better sense of all the players, let's discuss what it means to be a fiduciary. ERISA is the most significant piece of legislation that introduced the concept of fiduciaries being responsible for and liable for administering retirement plans. The legislation provides a very specific definition of a fiduciary. The first category of the definition states a fiduciary is anyone that exercises discretion over the management or administration of a plan, and this would include the selection, monitoring, and removal of service providers, and the management and disposition of plan assets, which would include monitoring the investment options in the plan. And many fiduciaries believe that that's their only responsibility. But as we'll see later, there are many other fiduciary responsibilities needed to manage and administer a retirement plan. The second category deals with anyone rendering investment advice for a fee, such as an investment advisor. The Department of Labor has provided guidelines to identify who's providing investment advice to the plan, which would be anyone advising on the investments on a regular basis, pursuant to a mutual agreement that is the primary basis for the investment decision being made and is individualized based on the needs of the plan. The final category acknowledges that even though a fiduciary may not act upon their discretionary authority, but is still responsible for administering the plan, they are still considered a fiduciary. And this category would include anyone that serves on a retirement plan committee. Under ERISA, there are two types of fiduciaries, which are based on functions the person performs for the plan, not just the person's title. The first is a named fiduciary, who is the fiduciary responsible for overseeing the plan and any other fiduciary to the plan. Typically, this is a board of directors or trustees of the organization, but it can also be another committee. You can reference the plan's adoption agreement to identify who is the named fiduciary for your plan. The second type of fiduciary is a functional fiduciary, who may take actions that deem them a fiduciary. The members of the committee are functional fiduciaries as they've been delegated to oversee the plan by the name fiduciary. BFSG is the functional fiduciary to the plan and has co-fiduciary liability with the committee. This is often referred to as an ERISA 321 fiduciary. ERISA is clear that if you perform the functions listed on the previous slide, you are a fiduciary, even if you didn't intend to act as one. When the committee decides they want to outsource some of their fiduciary responsibilities, there are three main types of fiduciary arrangements they can engage in. Each of these types of fiduciaries is a section within ERISA. So when I refer to a 321 fiduciary, I'm referencing section 321 of ERISA. A 321 investment advisor is considered a financial expert and has met the fiduciary qualifications defined by ERISA. For example, properly registering as an advisor, putting it in writing, they will act in a fiduciary capacity, and they're able to demonstrate expertise in advising ERISA plans. This type of fiduciary works for a fee and takes on co-fiduciary liability to the plan. For example, they may do the work of selecting the investment lineup and continually monitoring the plan to make sure it meets ERISA guidelines. However, under this arrangement, the 321 fiduciary is only making recommendations and carrying out the plan sponsor's decisions. Under this type of fiduciary arrangement, the plan sponsor retains ultimate decision-making responsibility for the plan. So if a lawsuit ever arises, the plan sponsor will bear legal liability if the plan is found to have fallen short of ERISA requirements. If a plan sponsor wants to offload almost all its investment fiduciary responsibilities for the plan, then a 338 investment manager arrangement may make sense. In this scenario, the 338 investment manager formally takes on the role of a fiduciary for the retirement plan as it relates to the investment menu. They will build the investment lineup and continually monitor the plan's investments to make sure they fall within the IPS investment policy statement guidelines. If a lawsuit ever arises, they bear the legal liability for the investment decisions, and the plan sponsor will bear liability for monitoring the activities of the 338 manager. While a 321 or 338 fiduciary involves investments, a 316 fiduciary involves the daily operations and administration of the plan and refers to a service provider who agrees to take fiduciary liability for administrative duties. It's important to note the role of a 316 plan administrator is different from a third-party administrator or a TPA, since a TPA typically does not accept fiduciary liability, but may take on fiduciary responsibility over certain functions, such as participant disclosures. The services of a 316 can vary widely. For example, some may file the 5500 and send out participant notices, while others may assume all the administrative tasks related to a plan, and all the plan sponsor needs to do is submit payroll. The 316 administrator role is becoming more popular for small plans, and several record keepers are offering these services. Fiduciary functions involve management of the plan, which can be both investment related and administrative in nature. Investment related duties include establishing investment policies to ensure there's a process for selecting and monitoring the investment options offered in the plan, ensuring the investment fees paid by the plan's participants are reasonable, and delegating any duties to employees or third parties. Administrative functions include ensuring operations are following the plan documents, such as proper administration of loans or distributions, complying with IRS, DOL, and other regulatory entities, and providing required notices and disclosures to participants, such as a fund change notice, fee disclosures, or the summary plan description, or SPD. Documents to review for fiduciary functions are the plan's investment policy statement, expense or fee policies, and a most recent investment performance report. And remember, when committee members are making fiduciary decisions, they're acting solely on behalf of the plan's participants and their beneficiaries. Settler functions involve company decisions about what types of benefits to provide to participants, such as establishing the plan in the first place, determining who can participate, and if there's going to be a matching contribution, setting a vesting schedule, and then making any non-required plan amendments. Documents to review for settler functions would include a committee charter, plan document, adoption agreement, and any amendments. When committee members are involved in making settler decisions, they're acting on behalf of their employer. A famous example involves the fiduciaries of the Enron 401k plan who continued to keep the Enron stock in the 401k plan even though they knew the company was falling apart. They were wearing their settler hat and acting in a fiduciary capacity when they decided to keep the company stock in the plan, and they should have been acting on behalf of the plan participants, not the company. Next, we'll talk about fiduciary standards that all ERISA fiduciaries are required to follow. ERISA Title I sets the framework for establishing retirement plans, and it's where the Act imposes the fiduciary duties of those operating ERISA plans. There are 5 main fiduciary standards as set forth by Title I of ERISA. The first is duty of loyalty, where you must act solely in the interest of the participants and their beneficiaries while avoiding any direct or indirect conflicts of interest. The conflict of interest occurs when a person's vested interests raise a question of whether their actions or decision-making can be unbiased. As a fiduciary, a conflict of interest could arise when you put your own interests before those of the plan participants. An example of a fiduciary breaching their duty of loyalty is when an advisor recommends funds that pay higher compensation. Prior to most advisors getting paid a flat or asset-based fee, there were arrangements where advisors were getting paid from the revenue sharing of the mutual funds, so they would be incented to have more assets moving to higher revenue funds. This is a great example of a conflict of interest and one of the reasons that the industry has moved to explicit compensation for advisors where their fees are no longer hidden in the mutual fund expenses. The second is the exclusive benefit rule, where you would be responsible for defraying reasonable expenses of administering the plan and ensuring that any charges to the plan benefit the participants. This requires the committee to monitor ongoing record keeping and investment fees on a regular basis, which is currently being done through the quarterly investment review meetings. This may be a good time to share a cautionary tale. We had a client that was going through an RFP, a request for proposal process, to conduct due diligence on their record keeper. Their current record keeper was a bank. Since they didn't want to damage their banking relationship and had an opportunity to receive more favorable credit terms, they decided to stay, even though their pricing would be higher and not considered reasonable when compared to other vendors. This would be an example of fiduciaries violating their duty of loyalty and the exclusive benefit rule because they did not act in the best interest of the participants and fees were not considered reasonable. Prudence requires fiduciaries to treat plan assets with skill and care. Therefore, the third standard is duty of care, which requires fiduciaries to act with the care, skill, prudence, and diligence under the prevailing circumstances that a prudent person would act in a like capacity. This is also referred to as the prudent expert rule, which holds fiduciaries to the standard of how a prudent expert would behave in similar circumstances. The duty to act prudently is one of a fiduciary's core responsibilities under ERISA. It requires expertise in a variety of areas, like investments. And lacking that expertise, a fiduciary may want to consider hiring someone with that professional knowledge to carry out the investment oversight functions, which can be done under an ERISA Section 321 or 338 arrangement, as we discussed earlier. The next standard is the duty to diversify. In the case of participant-directed accounts, like your retirement plan, fiduciaries can strive to be compliant with ERISA Section 404C by offering a diversified investment menu to allow participants to build a properly diversified portfolio. Therefore, it's important to offer a broad range of investment options so participants can make their own portfolio decisions. A common best practice in building an investment menu today is to offer both active and passive investment options in all of the major asset classes so participants can choose whether to build a portfolio using all active managers or index funds or a blend of both. The last standard is the duty of obedience, where fiduciaries are responsible for ensuring that the plan is administered in accordance with the plan document. This may require conducting an audit with the plan's record keeper to make sure that current provisions in the plan are being administered correctly. The most common issues that we see are automatic enrollment arrangements, where maybe employees are not getting captured correctly, how rehires are treated, and automatic deferral increases. The good news is recent legislation allows plans now to make self-corrections in many of these circumstances. You may be asking yourself if there's any liability while serving as a fiduciary. There is. Fiduciaries who do not follow basic standards of conduct may be personally liable to restore any losses to the plan. So let's pretend you're an HR manager of a small company. You and the finance manager have been delegated the responsibility of overseeing the 401k plan. Your role is to make sure that the plan is operating according to the plan document and that the company is following all the regulatory rules. The finance manager handles payroll and the contributions into the plan, along with selecting and monitoring the investment menu. One day you find out that the finance manager has not been making contributions into the plan, but rather absconded with all of the funds and is now vacationing in an unknown destination. So let's walk through ERISA Section 405 that outlines the 3 areas of co-fiduciary liability to see where things may have gone wrong. First, you didn't knowingly participate or conceal that the finance manager was stealing from the plan, nor did you have any knowledge of the breach. However, it may be viewed that you failed to comply with the duty of prudence by not confirming the contributions were being made, which allowed the fiduciary breach to continue. If it is determined that you breached your fiduciary duties, your personal assets may be subject to claims to make the plan whole, including your retirement account. And this can happen. It happened in the Enron case I spoke about earlier, where the fiduciaries were subject to a judgment to seize their retirement assets to recoup the losses in the plan. So back to our example, since the finance manager is nowhere to be found, you could be held liable for the entire amount of damages because the fiduciary liability is joint and several, which means a claimant may bring a suit against any fiduciary and recover the entire amount of damages, despite only being partially at fault. Therefore, it's important that proper monitoring systems are in place, so if one fiduciary fails to comply with their duties, other fiduciaries will not be held liable for the breach. And the personal liability of a fiduciary is generally limited to the fiduciary function that the person performs with respect to the plan. ERISA has several prohibited transactions that fiduciaries are not allowed to do, but for purposes of the presentation today, I'll just highlight the most relevant ones for retirement plans. Some prohibitive transactions have exemptions, so if you follow the guidelines, you can engage in the transaction, but most do not. ERISA Section 406 outlines 2 types of transactions that are prohibited by plan fiduciaries. The first is a transaction between the plan and the fiduciary called self-dealing. An obvious example would be taking money out of the plan to pay for company expenses. The second is a transaction between the plan and a party in interest, like a retirement plan advisor, investment manager, or a record keeper. An example of this type of transaction could be where the record keeper is giving kickbacks to the plan sponsor for using their services. As I mentioned earlier, some of the prohibitive transactions have exemptions. Sale, exchange, or lease of any property doesn't typically exist in defined contribution plans. The second one is lending of money or extension of credit, which is done through loans, which is generally prohibited, but we'll review the exemption on the next slide, since this is a widely used feature within retirement plans. The fourth prohibitive transaction is the transfer or use of plan assets. If you remember earlier in the presentation, we discussed the exclusive benefit rule, where the assets can only be used to pay for benefits. Plan assets can also be used to pay the fees of third-party providers, such as auditors, record keepers, and retirement plan advisors. The next set of transactions are strictly prohibited and do not have an exemption. These include using plan assets for your own personal use or your position as a fiduciary to receive any financial gain or consideration. Some examples that may constitute a prohibitive transaction would be when fiduciaries decide to change record keepers to receive a benefit like a reduced interest rate on their credit line, or when a CEO gets free financial advice because he hires the advisor to be the advisor on the plan. Let's take a look at the exemptions that are allowed under ERISA Section 408. The first is participant loans. As long as loans are available to all participants on an equitable basis, they have a reasonable rate of interest, and they are adequately secured, you can rely on the exemption to lend money to plan participants. And general loan provisions state a participant can borrow up to 50% of their vested account balance, or $50,000, whichever is less. And that 50% of the vested account balance is how they become adequately secured. The second is using plan assets to make payments necessary to operate the plan, as outlined in ERISA Section 408B2, which we'll review on the next slide. Plan fiduciaries should make sure that all services to the plan are necessary and that the fees are reasonable or a market rate. It's important to note that reasonableness doesn't mean the cheapest or the lowest fees, but they should be reasonable for the services contracted by the plan. Now that we have a better understanding of the liability that comes along with being a fiduciary, there are ways to lower that liability. Every ERISA plan is required to purchase a fidelity bond, also known as an ERISA bond, to protect against risk of loss due to fraud or dishonesty. In the case we discussed earlier, where the finance manager absconded with the employee contributions, the company could recoup some of the loss through the ERISA bond because there was fraud involved. Optionally, fiduciary liability insurance can be purchased to protect against breach of fiduciary duty claims. In this case, fiduciary liability insurance could cover any additional claims due to the fiduciary breach. Specifically, it helps defray fee litigation costs should a retirement plan sponsor or retirement plan committee get sued for breach. You do not want to pay for fiduciary liability insurance out of plan assets, because it will then only be able to be used to protect the participants, not the fiduciaries to the plan. It's also important to have a waiver of subrogation so the insurance company can't come back to recover any losses. The market for fiduciary liability insurance has been rattled by the proliferation of 401k excessive fee lawsuits. 401k plan fee litigation costs are rising, and employers may have to pay a hefty portion of the cost, some to the tune of $10 million or more, before their fiduciary liability insurance even kicks in, if they choose to defend a claim against the plan. So let's conclude with some fiduciary best practices that will help reduce fiduciary liability while also improving participant outcomes. The first is establishing clear lines of operating the plan at the committee level and as it relates to overseeing the investments in the plan. This can be accomplished by establishing governance procedures such as a committee charter or a set of bylaws and an investment policy statement. And I'll go into more detail on both of these on the next slides. Next, plan fiduciaries should make sure they have policies and procedures outlined when it comes to administering the plan, as well as staying up to date on the latest regulatory and legislative updates. Fiduciaries are also responsible for ensuring required disclosures are distributed to all participants, like the summary annual report, fee disclosures, and QDIA notices. And it's not only important to make sure the required notices are sent out to all plan participants, but that they're also accurate. So fiduciaries should make sure that they're conducting a thorough review of any notices sent to participants prior to distribution. The third item is to document. Prudence focuses on the process for making fiduciary decisions, which is why it's so important to document all of the decisions made by the committee and the basis for those decisions. And finally, fiduciaries can outsource duties where they may lack areas of expertise or experience to prudent experts. This typically happens in the area of investments, but it can also be when legal expertise is required, such as reviewing service agreements or updating plan documents. As I'd mentioned on the previous slide, a committee charter is a best practice. And through a charter or set of bylaws, the named fiduciary can delegate duties to a committee. These duties are separated into fiduciary and settler functions. When performing fiduciary duties, as I'd mentioned earlier, the fiduciary must act in the best interest of the plan participants and their beneficiaries. And when performing settler duties, the fiduciaries act in the best interest of the company. And to complete the cycle, The committee will want to report back to their governing body to help them fulfill their oversight responsibility, since they did delegate duties down to the retirement committee. Through proper committee chartering, employers can indemnify committee members from fiduciary breaches so that the company would pay for the fiduciary's defense in the event of a lawsuit. And one of the first steps in developing procedures around how to evaluate investment options in the plan is to have an investment policy. While a written document is not required by ERISA, it is considered a best practice in the industry. Your plan should have an investment policy statement that outlines the purpose of the policy, asset class guidelines, types of investments that will be offered, how the investments will be monitored on an ongoing basis, and what happens when an investment is underperforming or has a material change. This process will help the committee from making any capricious or arbitrary decisions. Another area that is important for a committee member to understand is choosing the plan's QDIA, or Qualified Default Investment Alternative. When the Pension Protection Act of 2006 was signed into law, provided a safe harbor for plan fiduciaries when participant assets were directed into a default fund that has been designated as a QDIA. A safe harbor is a statute under law that provides protection to fiduciaries for any situations where they could incur liability, such as directing participant assets. A plan may have to direct a participant's assets under circumstances where a participant never makes an investment election or has assets rolled into the plan where an investment election was not made. So designating a QDIA can protect employers from fiduciary liability in this situation. And as long as fiduciaries follow certain procedures and invest the assets in a QDIA, participants are deemed to have exercised control. And there are three major types of investments that typically qualify as a QDIA: a balanced fund with a stacked mix of stocks and bonds, asset allocation models that can take into consideration a participant's age and risk tolerance, or target date funds, where a participant's age is used to determine the mix of stocks and bonds and grow more conservative as the participant nears retirement. In addition to the QDIA, there are also other safe harbors to help limit fiduciary liability. ERISA offers safe harbors to plan fiduciaries to help reduce their fiduciary liability if certain provisions or conditions are met. ERISA 404C, which I'd mentioned earlier, shields fiduciaries from participants making bad investment decisions. If a participant decides to put all their money into an aggressive fund and it falls 20% during a market downturn, they couldn't come back to you and blame you for allowing them to make an inappropriate choice in their account. Therefore, 404C shifts the responsibility of poor investment results to plan participants. To qualify for relief under this safe harbor, the plan fiduciaries must provide participants the opportunity to choose from a broad range of investments, which allows them to be diversified among cash, bonds, and stocks, and exercise control over their accounts. The fiduciaries must also monitor the options to ensure they continue to be prudent investment choices for the plan. For those plan sponsors that want to eliminate small account balances of terminated employees from their plan, there is a safe harbor for mandatory cash outs, which allows vested account balances below $7,000 to be forced out of the plan as either a cash distribution for balances typically below $1,000 or as a rollover distribution to an individual retirement account or IRA for balances between $1,000 and $7,000. The threshold for this provision was updated to $7,000 with the passage of the Secure Act 2.0. These types of distributions are also known as automatic force-outs or involuntary distributions. In the event that a participant is unable to make an investment change for a period of time due to changing funds in the plan or moving to another service provider, there is a required notice that must be sent out to all participants, active and terminated, and this is considered a fund blackout notice. And in order to receive safe harbor protection for this type of transaction, there are specific procedures needed for blackout notices, which inform the participants of the changes and any time period for which they may not be able to trade in their account. And remember, ERISA is a process law. It's not about finding the best performing fund, but rather what process was followed by the fiduciaries to make their investment decisions. And this was stated in a leading court case of Donovan versus Cunningham. There are many resources to help guide you in your fiduciary role. The Department of Labor website is a good place to start to learn more about your fiduciary responsibilities, plan compliance requirements, and plan fees. You go to the Resource Center on the DOL.gov website. You can scroll to the retirement section to find additional resources. And we will be providing this presentation to you so you can click on these links as well. Thank you for listening to our fiduciary education training video. We appreciate you taking the time to learn more about your new fiduciary role as a committee member. And as part of our fiduciary services to your plan, we are available to answer any questions you may have about your role or the retirement plan. Please contact your BFSG consultant if you'd like to learn more.